Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 20th of October 2019. And while this past week we've been focusing our video attention to silver, such as does it act as an effective hedge against inflation, the gold to silver ratio, and is it important, what will be the next driver for higher silver prices, and does it have a promising future? Links to the videos are shown in the description box below. Bankers have been meeting in Washington to discuss all of our financial futures. So let's investigate. Yes, this past week, 14th to the 20th of October, the annual meetings of the Boards of Governors of the World Bank Group and the International Monetary Fund have taken place. This forum brings together central bankers, ministers of finance and development, private sector executives, representatives from civil society organizations, and academics to discuss issues of global concern, including the world economic outlook, poverty eradication, economic development, and aid effectiveness. Also featured are seminars, regional briefings, press conferences, and many other events focused on the global economy, international development, and the world's financial system. The agenda this week has proven to be quite diverse, and this year is one of the very few of these meetings that Illuminati Silver did not attend. That said, we have of course received reports, as well as seen what has been published to the media. Now, the subjects covered range from fintech innovators as drivers of inclusive economies, to decoding debt, biodiversity, to transforming Africa. But what is more relevant, and certainly to us, is what was discussed and broadly agreed upon about the way forward for interest rates and quantitative easing. Now, one of the aims of this channel is to try and cut through the guff and summarize basically what the conclusions of a given situation are. And in this case, it's as follows. 1. Low and or negative interest rates in Europe, Japan, and the United States are here to stay, at least for the foreseeable future. In other words, for many years to come. 2. Central banks may have to overtly finance government programs in order to obtain the fiscal spending governments require. Now, a quick aside for those new to this area, there are two main parts to fiscal policy: government spending and taxation. And monetary policy involves the use of interest rates and changes to the money supply to achieve relevant economic objectives. So central banks run monetary policy and governments control fiscal policy. So what has happened, and is still on the cards to happen, is that in order to stimulate the economy, governments constantly raises taxes to fund their programs, which actually hurt that economy. And so, central banks have in effect loaned more money to governments, usually in the form of buying government treasuries or bonds which the government issues, in order to prevent them raising taxes too high. Okay, so going back to our conclusions. 3. The trade war between the United States and China, and now developing with Europe, plus the Brexit fiasco in the United Kingdom, has served to worsen growth prospects, thereby, to a large extent, mitigating the gain such economic stimulus is having. In other words, it's making the global trade situation worse at a time when a normal recessionary cycle tends to kick in. 4. Yesterday, the IMF Steering Committee issued a statement saying, quote, "Member countries should employ all appropriate policy tools, individually and collectively, to mitigate risks," unquote. Now, for those countries with zero or negative interest rates, this means asset purchases will become the main policy tool. Europe and the European Central Bank being an excellent example. Initially, for countries like the US, it means lowering rates. But we have also had the US agree to a bond buying program, which we reported last week. And 5. Now this bit is a little technical. A very major concern is that when interest rates go lower or even become negative, investors search out those assets which are offering some form of interest rate or yield. In this scenario, such investments tend to be higher risk, thus the reason to offer positive or higher interest rates. So we see a move towards certain equity markets, the corporate bond market, and government bond markets, perhaps in countries that have a sketchy track record in terms of repayment. You see, we would all like to think that the natural course would be for investors to invest in gold and silver when faced with such dilemmas, and in some cases, this will be and has happened. However, most are programmed to obtain yield, and this is where their focus will initially lie. Meanwhile, governments have to be funded, and with negative yielding bonds, such as in Europe, with an ECB key rate at minus 0.5%, the only parties particularly interested in buying such bonds are the central banks itself, which the ECB has agreed to. Otherwise, governments won't be funded as tax revenues are insufficient for them to carry out their spending policies and commitments. Now, this problem does not only apply to the West. Central bankers from Russia and the Ukraine, for example, have already cut rates and undertaken to continue to do so. In other words, do what is necessary. Now, to show you how concerned those who attended these meetings are about the situation, we can quote the IMF communiqué issued yesterday. Quote, "The outlook is highly uncertain and subject to elevated downside risks, including trade tensions, policy uncertainty and geopolitical risks. We will employ all appropriate policy tools individually and collectively to mitigate risks, enhance resilience and shore up growth to benefit all. Available fiscal space should be used to support demand as needed, and monetary policy should aim to keep inflation approaching or stabilizing around targets." Unquote. Now, what we can tell you from our contacts is that almost every central banker and senior policy decision maker is highly critical of the US trade tariffs. Now, there are good arguments, each side in political terms, of this debate, and perhaps long-term economic terms. These tariffs are advantageous in order for the president to get what he wants, but for now, they're causing much more harm than policymakers are admitting. And even when these tariffs are lifted, a major stimulus will still be required if the global economy as a whole is to avoid a most serious recession. Now, it is generally accepted that the United States, and many listening won't necessarily believe this, but the United States is in a better shape than most of the other Western economies. And even China itself is now feeling the pinch, having downgraded its own economic growth figures this past week. Now, our best calculations from the information we have available and gleaned is that as far as the US is concerned, it can stave off recession for around 2 years, but we'll see interest rates fall to 1 to 1.25% in that time, and Fed bond buying perhaps increasing to $100 billion a month towards the end of that period. Enormous pressure will be placed on governments to work together to prevent what could become a global economic disaster. And even President Trump will have to conform, or he will very rapidly see himself removed, especially after the Republican primary nominees have been chosen, as Republican senators will not make a move against the president until their positions are secure. The best thing Donald Trump can do, in order to hope for any chance of nomination and re-election, will be to come to a deal with China, and relatively soon. And other countries, as we have often stated, will work as collegiately as possible to stave off impending doom. Will this all work? No one knows for sure, but frankly, in the short term, we can expect further loosening of monetary policy, even lower rates, and probably some form of government stimulus, either via tax cuts or infrastructure spending. These issues are not likely to come to a head today or tomorrow. But central banks are genuinely concerned that their powers and abilities can only stretch so far. And without further government cooperation and mutual agreements, the economic ship will eventually sink. But the good news for us on the Titanic is that we're still quite a distance from the iceberg. And unlike Captain Edward John Smith, we can see it and know if we ram it exactly what will happen. Thank you for listening. Do share your thoughts. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.